Good afternoon, everyone. Thank you for joining us. My name is David Scherer. I am co-CEO and co-founder of Origin Investments. I'm super excited today to have Jay Parsons with us. I'm going to introduce Jay in full in a moment. I want to talk a little bit about Origin as well. Many of you are investment partners. Some are just interested in the content today, and either way, you're more than welcome. Origin is growing rapidly. We remained a top decile manager since 2015. This is our 7th year in a row getting that designation. We're really proud of that, our ability to protect and grow our partner wealth alongside our own. But enough about that. The format of this will be about 30 or 40 minutes of what I expect to be a very robust conversation about market conditions, challenges and opportunities within those between me and Jay. And then please use the Q&A feature. That'll help me organize the Q&A, and we'll have a live Q&A for 25 to 30 minutes. Jay's been very kind to offer a little bit more time if we run over. I don't know if we will or won't. I'll try to be very judicious with time. So with that, I want to introduce Jay. He deserves more of an introduction than me. Jay serves as Senior Vice President and Chief Economist for RealPage, and he leads the industrial principal teams, providing insights on market trends and consumer behaviors. He's a frequent author. I read a lot of his stuff. He has wonderful posts and comments to articles, and we'll talk about one of those in this presentation in the Wall Street Journal. He had some really insightful response to that article. And he writes about rental housing, obviously very relevant to Origin. That's what we focus in, rental housing, asset management, rental housing policy issues, risk mitigation, property management. Jay's really been everywhere, Wall Street Journal, Bloomberg, Financial Times, The Economist, New York Times. He's been on CNBC, Bloomberg. He's been published by Barron's, Real Estate Association, Mortgage Bankers Association, Globe Street, American Banker. Jay, I have to stop because we have to get started here, and your resume is quite long. But welcome, first of all. It's an honor and a pleasure to have you with us.
Yeah, well, thank you for having me.
I want to jump right in, and we were having this conversation briefly prior to this, but I want to unpack it a little bit. So I asked you a question because I know you write and think about this a lot. What do you think the most important variable is? And I'm going to make it about multifamily valuation and multifamily returns, but you can extrapolate this out because I actually believe this is applicable to industrial or office or retail. But when you're looking at EBITDA growth or NOI growth, and then ultimately asset level growth, what are the most predictive variables of that?
Sure. Well, I mean, you could get this as, some people make this very simple, some make it very complicated, but at the end of the day, it's really about people. I'm a big believer in, you want to follow the demand, follow the, where you want to be, where people are going. We look at, in the multifamily market in particular, we do a lot of analysis trying to figure out the best drivers in each individual market, as I know Origin does as well. And the most predictive variables tend to be demand side metrics. It's population growth, it's migration, it's jobs, it's stuff that's not terribly surprising. There's some markets that behave a little bit differently, but for the most part, it's you want to be where people are and where they want to be.
So I completely agree. Some other things that maybe you can unpack a little bit, this notion of affordability. There's people that want certain things, but maybe they can't afford them at given rents. And then also this idea of units per capita. So that's integrating growth with existing supply, and that'll segue into our next. We'll dive a little bit deeper into supply, but I think we should introduce this idea of affordability and units per capita, and then framed within what does that mean?
Yeah, well, I think affordability is probably one of the greatest misunderstandings in rental housing. The reality is that affordability is it's a multi-pronged issue. When you look at specifically the market rate rental market and apartments, there's been ample demand at these higher prices that we've seen these last couple of years. In fact, when you saw the biggest run up in rents in 2021, early 2022, that's when we saw the biggest demand in history. And at the same time, we saw rent collections were in the mid to upper 90% range. We saw incomes for new lease signers were growing by double digits. And so, there's, when you look at rent income ratios, you look at rent collections, specifically to who lives in these apartments, the numbers are very, very healthy. You don't see the red flags there on a macro level. Obviously, there's always assets that have issues or in certain submarkets. And part of it too is, whether you're a mom and pop, an institutional owner, or anything in between, everybody's screening to doing some type of, affordability analysis. Same thing with mortgages, making sure you're not leasing to somebody who can't afford the rent. So there's some natural barriers in place. Now, that being said, the real affordability challenges are that there's a huge contingent population that can't afford to buy or to rent at today's market prices. That's a whole separate issue. And so I think one of the reasons you see a lot of bad headlines sometimes is they're conflating the entirety of the population with the segment of the market that's serving market rate renters. And the reality is that the median income renter is not the one who's living in an average market rate apartment.
So, Jay, do you think that the ratios that we typically used to look at, kind of being in the low 20s, mid 20s, high 20s, and you didn't really want to cross 30 as an affordability ratio, do you feel like that's changing?
No, in fact, we analyze this in our data. In RealPage, we were able to process all these lease applications. We have millions of units running on our platforms. And, my job is I get the good, fortune of being able to look at all this great data in aggregate. And what we've seen is that, there's a lot of ways to do affordability analysis. I think the best way to do it is to look at what's the rent that someone's signing a lease for, and what's the income that they have for that same person, that same household, I should say. And so we're taking the ratio for each individual lease signer and looking at the median ratio. And what we see is that that number has hovered nationally in the low 20% range for the last decade. Now, it has gradually gone up a little bit, but it's like 22 to 23%. It's not 22 to 40% like you see in some of these headlines. It can vary. It's a little higher in Class C. It's a little higher in certain markets, but generally speaking, you're not going to see, as a general rule of thumb, nobody's leasing people spending more than 30% of income on rent, other than in like LIHTC or Section 8 housing, where they're pretty much having to spend 30% as a government rule of thumb. So ironically, the poorest portions of our population are having to spend the highest share of income on rent.
Got it. And let's unpack units per capita, because you were mentioning demand being the driver. Demand side. Obviously, you get a lot of headlines, and we can maybe transition in supply, but units per capita is simply saying how many units are being delivered relative to a demand function. Demand being defined by population growth. That's a little slippier. Candidly, supply and demand is slippery. You have to really dig in to find either. But why don't you speak a little bit about the fundamentals of supply, short term and longer term?
Yeah, that's a good question. So, when you look at supply and demand, you said it's a complicated issue. I mean, you look, you see some headlines saying, there's one famous analyst who last year said we're already oversupplied. You see other headlines saying we're undersupplied by 7 million units, and then you see, okay, there's a lot of supply right now. What's that relative to the population? Well, all of these things, they all could be true, but only to a certain degree. And so for example, one of the reasons, I think just a simple supply versus, per capita analysis, or supply versus jobs, is sometimes a little misleading, is it assumes that the base is rational. It doesn't account for undersupply in the past. It also doesn't account for vacancy in the market. And so you could have, if a market has very low vacancy, there's very little absorption historically. And so it makes the numbers look different than a market that has structurally higher vacancy. So the other thing, though, I'd point out, David, is that when you look at what really is undersupplied, you have to account for, okay, well, what's the demand? And that varies based on price elasticity, right? And so if you look at just what's affordable today, or you just look at just today's rents, today's prices, that's a smaller number of people who can afford that. If you look at the entirety of the population who would live in housing if they could afford it, that number goes much higher. So I'm generally of the camp that there's a massive supply shortage in our country, but that most of the supply coming in is catering to upper income population, and that the greatest section of need is actually the low and middle income part of the population.
There's been a lot of talk about how much supply is being delivered, and that's
Yeah.
not that slippery. I mean, there is a lot of supply being delivered, and my personal opinion is it's the logical outcome of 0% interest rates in 20 and 2021 that allowed a lot of developers to start deals. And typically, garden and wrap take about 2 to 3 years to build, and here we are, right? We're on the other side of that. They're being delivered. So I guess, first of all, do you disagree with that thesis? And then secondly, or agree? And then secondly, what does it mean? Because objectively, there is a lot of supply in the next 12 months hitting the market. People disagree about the magnitude or even the relationship, as you just mentioned. But there's a lot more supply hitting the market in the next 12 months. What does that mean for rents? What does that mean for occupancy? What does that mean for NOI in the short and medium to longer term?
Yeah, that's the big question right now. It's probably the topic I get asked about more than anything else. And first of all, to your point, I mean, low rates definitely made it more attractive, but also, existing assets have been so expensive that in many cases we're seeing investors the last couple of years have said, hey, it's cheaper to build than to buy right now, and they're willing to take on the development risk. So where we are right now is that, as you alluded to, we are building a lot. I mean, there's no way around dancing around that. It's you've probably seen the headlines that multifamily construction is the highest levels in 50 years. Now, the one thing I think oftentimes goes unnoticed about that is that 50-year high, or basically 1 million units under construction. Well, 1 million units today is not the same as 1 million units 50 years ago, and that's because today's apartment stock is twice as big as it was 50 years ago, which means that the expansion rate of supply is less than half of what it was back then. There's also twice as many working age adults between 20 to 64 than there was 50 years ago. So there's more potential demand for those assets as well. And lastly, I would also point out that today's projects, as you allude to, it's 2+ years to deliver these things. Units linger around the construction numbers much longer. So actual starts actually aren't as significant as they were back then. But these properties are bigger and more complicated to build, and obviously, more local encumbrances as well. And so it just takes time. So to answer your kind of the punchline question here is what all this means. We're of the view that there's gonna be a lot of noise in the next couple of years. I think the segment of the market that is catering toward you're competing for the lease-up renters, which are typically 6-figure income renters, and a lot of it's in and near downtown areas. It's going to be really challenging leasing environments. A lot of competition in those spots. I think the short term is that some of these lease-ups will take a bit longer to complete, but I think long term they're going to be fine. I think that by the time we get to 25 and 26, there's a lot less supply in the market. We're seeing already a big drop off in starts this year due to construction financing availability and just the general economic conditions and concern about the existing supply pipeline. So these lease-ups take a little longer to complete, but in the long run, the demand will be there. And then more importantly, I think most of the markets, and I'm a little bit, I think, different from a lot of our analysts on this topic, but I think most of the apartment market's actually somewhat insulated from supply, in part because we see supply that's not really, there's 20% of the United States submarkets are not seeing any supply at all. And in particular, you have a lot of suburban areas that aren't seeing it. And not that some are, obviously not all, but also the other thing that kind of goes unnoticed is that your average Class B apartment is 28% cheaper in rent than an average lease up. And so that means that while there could be a long-term filtering impact from new supply, in the short term, you're not drawing Class B renters up into brand new lease ups. It takes 4 months of free rent concessions to get there. Plus, they have to qualify at the non-concessed rent level to move up. So over time, again, there's a filtering theory I think plays out, but in the short term, I think most of the market's actually pretty insulated.
So it sounds to me like you're not in agreement, because I'll be candid. We believe Origin has developed our own machine learning. We were talking about this before, and we've done many webinars on this for our investors. We believe it's the best in the market. It's been incredibly predictive, and it's predicting negative rent growth in 2023. And when I say that, I mean everywhere. Because when I talk to investors, they say, "Well, yeah, but not in Austin." I'm like, no, in Austin. That
Oh
there's
yeah, Austin's negative already.
or not in Nashville. No, in Nashville,
Yeah.
etc. And but I don't want to sound like I'm bearish. I'm not. Then it actually goes very positive the next year, and it goes
Yeah.
positive in 25, and the long-term growth rate is quite strong.
Yeah.
However, in 23, again, this idea of the metaphor I make, or the image is, we have a snake that's swallowing an elephant. And when the snake's done, he's going to be really full. And that's this year. There's a lot of supply. And then what happens is in a couple of months, the snake's hungry and there is no next elephant. And the reason, and I'll tell you, I totally agree with what you just said, Jay, because we're in it. We're one of the larger developers in our regions in the country, meaning Texas, Southeast, Southwest. It's very hard to get new developments off the ground. Very
Yeah.
hard.
Yeah.
And we'll get to the other side of the equation, which is operating costs. And there's a lot to talk about there too. But
Yeah.
when you look at construction costs that aren't going down yet, in some submarkets slightly, they're not going up anymore. But think about what happened. So if they go up 15, 20% 2 years in a row, and then they don't go down, it's like you used to pay $50 for a steak. Now it's 75, but it's not going higher. It's still 75. Right. And so now we have rents flattening, and we know that's true, right? I believe they're going to go negative, but it's objectively true, they're flattening.
Mm-hmm.
Borrowing costs are higher, cap rates are higher, multiples are lower, operating costs are higher. It's hard to get a deal to work. And then on top of that, the lenders are scared. And that's a whole nother
Oh
that's
yeah.
a whole nother conversation point. But what, in your opinion, has the run on, SVB, and then, First Republic, and, Pac West almost went under, and they just sold their loan book, and, all the regionals are basically panicked to guard deposits. I mean, that's where they're at. How do you think that has affected the ability of new housing stock?
Oh, I think it's a big deal. And by the way, I largely agree with you. I think especially I think the only difference on the short term is just the depth of it. But I think we're going to see a lot of places that are seeing rent cuts for sure. But on the banking question, it is having an impact. And, I think one thing that I'm concerned about is, I think some of the unintended consequences of the regulatory, push on the regional banks, which is, where there's very little kind of precision focus on, hey, let's focus on potentially problematic loan practices. Instead, it's like, oh my goodness, you have CRE and multifamily exposure. We need to pull this back. And these things aren't new. I mean, a lot of these regional banks, like the ones you mentioned, like Signature, the small regional banks don't have the ability to focus, have a specialty in every single potential loan category. Some of these banks have specialized lending groups for these business lines. And so in the case of like Signature, for instance, they had a large multifamily book that was in very healthy shape. They had very little delinquency. And yet like this crackdown is, I think, potentially troublesome. And what could happen is as these loans need to be refinanced, there's going to be less liquidity there from the banks, about a third of multifamily loans or bank loans. And that potentially could boomerang back on values and potentially the value of these bank loans. So I think it's a worrisome thing for banks that what's happening right now. Now that being said, multifamily, unlike office, has the backstop of the GSEs, and they've shown a good willingness to step in and fill the gap. So I expect that'll remain the case.
Yeah.
But
And
last thing I'll
just
say,
to define that, Jay, because we have a very broad group. I think define when you say GSEs, what that means.
Oh, sure. I'm sorry. This is Fannie Mae and Freddie Mac. So the big agencies. Yeah.
Yeah, and also I would group HUD into there as well, because multifamily. This is one of the reasons we've selected it as an asset class. So 15 years ago, when we're forming the company, where are you going to focus? You need to focus, in my opinion, somewhere. You can't, to your point, you can't be good at everything. And so, well, this is the highest returning asset class in real estate over the last 30 years. It's the lowest standard deviation. That's very rare. I mean, show me an investment that gives you both. And then on top of that, you have this backstop lending that actually doesn't exist in any other asset class.
Yeah.
So when the credit market's shut, or just maybe that's being melodramatic, but when they're less readily open, we have these other ways to finance that don't exist if you're sitting in retail or
Yeah.
office or hotel. They don't
Yeah.
have their corresponding Freddie Mac.
Mm-hmm. No,
Right?
you're 100% right. The only thing they don't really do is the construction loans. And so that does create some issues for future construction. So if you are delivering in 25 and 26 and able to get a bank loan for that, you're not competing with a whole lot at that point.
That's a really good point, and that's really central to, I believe, the thesis of multi. So you can respond to this. This is my thesis. I wouldn't even call it origins, but I believe that we're watching sort of the second chapter of what happened in 08 to 11, not in the sense that we're going into this huge recession, and I'm not suggesting it'll be like that, but what is happening is there's very little new housing being started. And the data will come out in an official way later, but I'm living it. I will tell you that in Q4, in Q1, in Q2, in the last 3 quarters, it is just massively slower. And so it mirrors what happened in 09, 10, and 11. And if we have a housing shortage, you can trace it back to those years. And we're right in the middle of the next chapter of it. And so if you look out into 2024, 25, 26, don't be surprised if owners of multifamily real estate have pricing power. Like it's coming.
Yeah. It's all
That's
cyclical.
my thesis. Do you agree? Disagree?
I agree with you. I mean, it is cyclical, right? I mean, everyone's worried about supply now, and then we pull back, and there's not enough then, and then rents go up again. But also, I think a lot of people don't understand the timing of how. I mean, you obviously do, but maybe people watching do, and certainly I think the broader public at large. People saw the big start numbers in Q1. They're like, wow, multifamily is still going, but they don't understand, like, it's a 3 to 6 month delay period between time you get your deal approved and financed to when you actually break ground. And so to your point, the official stats, it's not going to show up really until the second half of the year when there's just been this big drop off that you and I know has already happened. It's just that the government data is not showing it yet.
Yeah, exactly. So I do think we need to touch a little bit on operating expenses, because I did kind of tease that before. What are you seeing on that side? And what would you say is moving in what direction and at what speeds?
Yeah, no, I mean, it's a huge topic. I'll tell you, I've been in rental housing economics for 14 years, and I don't remember ever talking about expenses more than 2 seconds until last year. And now it's like, one of the hot topics. And meeting with a lot of our clients and, the investments and operating side, that was during budget season, big focus, because what's happening is everything's more expensive. And I think what's really interesting in the cycle is that expense or OpEx inflation has really trailed rent inflation. And so the implication to that is that if you've held for a long time and you've enjoyed the revenue run up, you're probably fine. But if you're, bought at peak prices with cheap debt and are facing refinancing, all of a sudden, your expenses are looking pretty problematic. The cost of debt service is obviously way up, and we've alluded to that, but that's especially, it's kind of like at homeowners, but if you bought at that low rate and you're a long-term holder, it doesn't matter, you're fine. And that's a lot of multifamily, especially with Fannie and Freddie debt. But if you bought with the equivalent of an ARM, which is the, short-term floating rate debt, then all of a sudden your mortgage bill, essentially your debt service, can be 2 or 3x what it was previously. And that's hard to pay. And then at the same time, especially in the Sun Belt, like Florida and Texas, Southern California, your property insurance premiums could be 2 or 3 times what they were, 2 or 3 times. That'd be like coastal cities. But like in some of these places, they're 50% more than they were the last year or two. So there's a lot of expense plus payroll, utilities, property taxes. Pretty much everything is more expensive, as you know. Yeah,
you covered it. Insurance is the big one. People don't realize that it's up 30, 40, 50, 80% in the coast. Yeah. And what happened there was you had insurance companies, the big storms happened. And, it was flooding in Florida. It was Houston multiple times. And so there's a lot of insurance companies that have left the business. There's a lot of insurance companies that have struggled, and now they're trying to recoup that with much higher premiums. So I know there's a lot of industry people on this webinar. I also know there's a lot of investors on this webinar. I can't stress to you enough, you have to understand each input in real time. So if you're picking a manager, then you're selecting the manager to do that. So really spend time on diligence of that management team, how they risk manage, what the consistency of their team is, their process. If you're trying to invest deal by deal, you have to understand finance. You have to be able to get into the model and understand the model. But more importantly, you have to be able to understand the defensibility of inputs across the board. And there's many of them. And so I would really suggest, if you're investing, just for argument's sake, $100,000 into a deal or $200,000 into a deal, if you're a deal investor, which I generally don't think you should be, but if you're going to do it, hire a consultant, hire somebody, call Jay Parsons. because I can't, if you told me to underwrite a biotech company, I could understand the discounted cash flow, but I don't know the defensibility of inputs. I wouldn't be able to do that. So I'm not smarter than you. I just understand this because I do it every day. You will not ever get what you need from a sponsor who is selling you his or her deal. That's not it. Jay?
Yeah, I mean, I mean, this has been the news lately, and I think a lot of investors are having to really think about their models and how it's distinguished from the stuff that's making the news right now. And a lot of that, like you said, it's just being smart about the inputs. If you're assuming that if you're assuming cap rate compression and you're assuming you're magically getting expenses down, despite everything going on, by without clear plans on how to do so. I mean, it's certainly possible, but you have to have a clear plan on how to do it. And value adds another one. I mean, honestly, like you could have seen value add trade out rents, which just higher rents in the last couple of years by doing almost nothing. Well, now it's not that easy, right? It's getting a lot more challenging, especially as you kind of move into the Class A space. You're competing with supply. So I fully agree with you. I mean, I'm a data nerd. So I'm all about just making sure that the data makes sense.
So you had some great commentary on a Wall Street Journal article that came out, was it about a week ago now?
Yeah.
Why don't you talk a little bit about the article, because it really speaks to what we're talking about now. There's an awful lot of people in private investments that don't have your interests at heart. They just don't. And I'll just call it what it is, and it's buyer beware. That's what the article's about. To be clear, the folks that wound up losing investor capital, in my opinion, in this article, they weren't of the quality necessary to manage risk or operate multifamily buildings on the behalf of another client, on a part of a partner. And you wrote a little bit about that, but why don't you talk about the risks? And you did briefly, but again, starting with buying an asset at a 3.5 cap, a 30 multiple on earnings, and then using variable debt, and just keep going.
Sure. So if you missed it, the article, I think it was titled "A Housing Bust Comes for Thousands of Small-Time Investors." Pulled up so I remember that title there. And it's specifically, in this case, talking about syndication groups that had raised money from a lot of very small investors and had used very generous assumptions, or the inputs as you called it, and bought at peak prices 2021, early 2022, using floating rate or short-term floating rate debt. So what their strategy was, and by the way, obviously not every syndicator does this. This is definitely a pocket of the market. There's very good syndicators out there too. But what the article was highlighting was those that are essentially like kind of like the single-family version of the flip, or the multifamily version of a single-family flip, which is we're going to buy this asset, we're going to do some renovations, we're going to renovate, we're going to renovate it, we're going to raise the rent, and then we're going to either cash out, refinance, or we're going to sell at a much higher value. And so they're gambling with short-term debt. And what's happened is the situation where all of a sudden the expenses are much higher. The trade out rents, which is basically the, upon turn of a lease, what they're able to get for that renovated unit, even if they did renovate it, is not where they hoped it would be. Plus, now they're facing refinancing or expiring rate caps at a time when the rates or the cost of debt is significantly higher than they had expected. And in fairness, nobody, 2 years ago thought that rates would increase as much as they have, but the strategy was high risk for that reason. And so unfortunately what's happened is, and it's only been a handful of cases, but so far, but in some of these spots where all of a sudden they can't pay the debt service anymore, and then all of a sudden the property is worth less than less than what they paid for it. So it's with high leverage as well, and so they're really in a bind. And I think we will see more of that in the next 18 months or so. But I also think it's a pretty small part of the market, but it's going to be a pretty loud part of the market over these next 18 months.
Yeah, I was sitting at a panel with another manager about a year ago, and he had a question. He was very active in the value add space, and the problem with it, and by the way, Jay, to be clear, we didn't talk about this, but for everyone on the webinar, Origin, and we're a very large company, we haven't bought a multifamily stabilized building in 3 years. So think about that. We haven't bought a building since the month before COVID, 2020. And there's a reason. It's because we thought it was all overvalued, and then it got even more overvalued. And, candidly, some of the stuff you could have bought in early 21, it went up, and now it's back down. And it's been very volatile, but it's kind of normalizing into sort of the long-term growth rate, which is kind of interesting. It just went up a lot and back down. And but nonetheless, value add investing there's a huge risk to it. And
Yeah.
you should speak to this, because when you finance it, it's virtually impossible to finance with long-term fixed debt.
Yeah.
And there's a reason, right? So I know, so why don't you unpack that a little bit?
Well, I think there's probably lots of reasons, and I'll let you expand upon if I miss it. But part of it is that most the lenders aren't going to let you assume future rent growth based on your renovations, and when your strategy is dependent on higher rents driving the higher value, you have to use short-term assumptions in order for that to work, and therefore take higher leverage, more risk. You can't go to Fannie and Freddie and say, look, I'm going to do all this great work and then raise the rents 20%. They're not going to buy that.
No, and Fannie and Freddie lend to cash flow today. So you'd be locking in cash flow today. So you're absolutely right. So value add, it starts with, I'm going to raise rents 20%. And if you look at a value add deal, you're looking at, in an ideal world, you're paying kind of a core price, but then you're putting in, just for argument's sake, 20,000 a unit, and you're going to get an unlevered 25% on that capital, or 20%. And when you hear things like payback periods, I mean, that's what they're doing, right? Like that's another way of quantifying unlevered returns. And so now you're driving higher NOI, and the idea is, let's use a variable rate loan while this is happening. We're going to then drive higher NOI, and then we'll move it to fixed later. And that's a really risky strategy when interest rates are zero and your variable rate loan is a spread to a zero SOFR. So, let's, for argument's sake, you get 300 over, but SOFR's 0.2, so you're borrowing at 3.2. Well, now SOFR's 5, so you're borrowing at 8.2. Well, that's a lot more than 3.2 last time I checked.
Yeah.
So that's going to hurt. But then, of course, along the way, when your borrowing rate goes up that much, eventually it's going to start to trend into the cap rate, because no one likes to borrow more than their cap rate, their return on cost. And so that's happened, right? So now they bought a 3.5 cap, but it's really now it's 4.6, but their cash flow is also underwater, but they're building LTVs way down because the multiple's down. And here's the key point. Here's the worst part. that bridge loan was for 3 years. It's not like the bridge lender just says, hey, I'll lend you money for 10 years. That's not how it works. So now you have a cash flow problem, you have an LTV problem, and you have a duration problem. And that's the trifecta, right? So I'm sitting at a year ago, and this is early on in the tightening cycle. I'm sitting with a CEO who was extraordinarily active in 21. And the question was, how do you feel about the Fed starting to raise rates? And to his credit, he said, I'm nervous about all the bridge loans that we took out on the value add deals. And he had done billions. And I literally was looking at him like, you're actually, your firm it's going under. This is going to be a slow nightmare for you. And that's where I see this going. And to be clear, this is not a fundamental problem. Multifamily remains, in my opinion, the best asset class in real estate. This is a valuation problem and a behavioral problem that has to be worked through. And let me transition to opportunities. What do you see as the opportunities? And by the way, I could be wrong. There are other ways this could work out. Interest rates go back down, right? That's one way that things work out in a more friendly way. It could be that I'm wrong about rent growth, and that growth provides enough value creation so that it also lets you out. But what do you think the opportunities are, and what are the probabilities of how this ends? Let's just say that.
Well, I think one thing that's important to point out is, regardless of our outlooks on rent growth being slightly different, I don't see it as a revenue issue right now, because most responsible underwriters could withstand slight rent cuts, and it's not going to go double-digit rent growth again. And so we're talking about a relatively tight band of where rents could actually go in a barring some massive shock. So it's really about what happens with the expenses and with values, and obviously it's really all about rates as I see it. I mean, it's just what happens with that. And so here's the good news. And to your point, I think the sector overall is in good shape. I mean, you look at the Federal Reserve maintains a data set on where all the multifamily debt lives, or not just multifamily, all sectors. There's $2 trillion multifamily debt. There's about 4% of it that's in which would be kind of high risk areas: CMBS, CLOs, debt funds, things like this. That's where a lot of this messier stuff exists. Okay, and so it's not insignificant, but it's not a systematic risk. Most of the debt is owned by Fannie Mae, Freddie Mac, FHA. That's a little more than half of all U.S. debt for multifamily. So in terms of where this goes, I think a lot of it's untouched. It's like, again, the homeowner analogy of those who locked in at low rates. They're paying a lot for the mortgage because they bought at peak prices, and maybe the values have gone down in some areas, but their mortgage payment is still manageable. I think a lot of apartment owners are going to be in that spot. They're fine. They're in they can't sell right now. They don't need to sell right now. There's no urgency to sell. They're going to hold. On the other side of this, you're going to have some of these short-term value add strategies that did very well past few years, but all of a sudden are going to be in some challenging situations. And they're going to have to either, if they have flexibility with their lender, you'll see some, workouts and whatnot, loan extensions. Otherwise, you'll see some. I'll tell you, there's a lot of preferred equity capital out there that's trying to inject into the top of the capital stack in these deals at very favorable terms. And some investors have no choice but to take that on in order to salvage their deals. And I think the ones that can't do one of those two things are going to be in the minority that end up in a default situation, or a foreclosure situation. So I think there will be investment opportunities. I don't think it'll be as significant in volume as some people out there think it will be, but there definitely will be some opportunities.
Yeah, it's interesting you brought up preferred equity. Can you unpack that a little bit more, and maybe I'll add on to a little bit. But I'd like to really, what I'm looking for is what is your determination of opportunity right now? If I'm an investor that wants to invest in multifamily, or someone that's in the space looking at the environment.
Yeah, that's a good question. So there are a couple of things I would look at. Is number one, we talked about lease ups earlier. A lot of that is going to be, merchant builds that need to find an exit. And I think you're going to find certain opportunities. It's again not systematic, but I think there's going to be deals, particularly smaller developers with less access to additional capital that they need to raise, and you'll be able to potentially buy at pretty favorable pricing. I mean, maybe even closer to cost, and I think that'll be a real opportunity given the volume and given the challenge of some of these properties to meet pro forma. And then there's the preferred equity route, that's where you have some of these potentially distressed deals with short-term floating rate debt. They need to raise additional capital to pay that mortgage off every month. They need to be cash flowing, or to cover the gap, I should say, or to pay for the new rate cap. They need more capital to pay these bills, is the best way to say it. And so preferred equity comes in there, basically jumps on top of the capital stack at very favorable terms. And if there's still a problem, then all of a sudden preferred equity usually has an option to take over the asset.
Jay, let me introduce the term and you can define it. This is sort of a new term in multifamily real estate. The cash-in refinance.
Yeah. The cash-in refinance, I think, is you can probably define this better, but basically, instead of the cash-out refinance, taking money out, you're having to put in money to then refinance with permanent debt, and that's part of what the preferred equity strategy would be as well.
Yeah. So this is the environment. Back to you have less free cash flow because the borrowing cost is higher. You have a term that's probably coming up in 6 months, 3 months, et cetera, meaning you had a 2 or 3 year loan that's due. The LTV is lower, but then layer on the next problem. There's a fourth leg to the stool that's also bad. The banks, whether it's Fannie, Freddie, they're not banks, but those lenders, HUD, or any of the regionals, they're all lending less too. So you're starting at a lower valuation based on debt service or LTV. And then they're saying, oh, we used to lend to 68, but how's 58 sound? I mean, that's where we're at. I mean, if you get 58, that's pretty good.
Yeah.
And so that's the cash-in refinance. You've created value, you think, and then you go to cash out or refi, and they say, okay, well, that's great, but write me a check for 10 mil. And that's the market we're in, and that is also the opportunity right now. Preferred equity is able to fill in that gap to take you from 58 in this case to 70. You're typically getting anywhere from 13.5 to 15 on that position, and you sit in a more protected position obviously than common, their first loss. So the first 30 is common, and then you're next. And by the way, if that doesn't work, if firms like Origin, we're really active in the preferred equity space, all phases of it, stabilized, construction. We did over 250 million last year, for example, just in pref. If we're not able to solve these through recap, then the natural next place is the banks taking the asset, right? If you can't recap, now what are you going to do? You tried to refi, you had to put in money. Firms like Origin analyzed it and said, well, wait a minute, it doesn't make sense for us at 14 or 15. We actually don't want to take that unit of risk. What do you do now? Like, there is no next game. You hand the keys over and hope you don't have recourse. Would you agree?
Yeah, in fact, it's interesting. The one case that the Wall Street Journal highlighted was a situation like that, where they hand the keys back to the lender, and the lender didn't actually lose any money. They just immediately had a buyer lined up who bought it. And, the lender does, I mean, as long as they're not losing money, the buyer's buying it at probably, I don't know what the price was, 25% discount. I mean, something like that, I'm guessing. So, yeah, I mean, it's not like it's going to be an REO for a long time.
No. And even though we own and operate, we never do pref with the idea we want to take over an asset. That's never what we want to do. We want to be successful for our partner too. But by the same token, you do have to protect your own equity too if it gets down to that position. Much as the lender is your partner, I view a lender as a partner. They are a partner, but those partnerships diverge if things get tough, right? Then you start looking at your own interests a little bit more. Any other opportunities you see in the market before I move into live Q&A?
Well, that's a good question. I think, you know, I'll tell you, I'm guessing, David, you're probably the same way. As I'm still bullish in the long term. You know, I think a lot of what's happening right now is not so much about, you know, fundamentals of the desirability of the rental. You know, those things are very much intact. And so I just think, generally speaking, that if you're able to make, you know, long-term hold acquisitions on deals that just make sense, even if the pricing is not quite as discounted as you may have hoped for, I think those deals still work. You know, I think the one thing that just doesn't work right now is a short-term hold and value add flip strategy. That's where I would, you know, be cautious of. And even I think new development can still work, especially if you're delivering in 25 and 26. I think that's a great time to be delivering.
Yeah, I had that conversation yesterday. We're introducing our third opportunity zone fund, and
Oh yeah,
we're one of the larger firms in that space, probably the largest in multifamily focus only. And so the question was, why now? And actually, I'm incredibly bullish on our third fund because we're now solving for a 6 to 6.3 return on cost. We need to have that 30 to 35% margin, but it's based on a 4.6 cap rate. I mean, you know, a year ago that cap rate was 3.8 to 4, right? So we're basing on a higher spot cap rate, and then all of the inputs that we're talking about, whether it's, and we use negative rent growth because that's our belief, or in the short run at least, or we use these high operating costs, which, you know, it's difficult for me to believe that insurance can continue to go up at that rate, but yet we're using that rate and the growth rate on top of that. We're drifting our cap rate higher in the future. So like, my point is, when I look at this, I really like the expected values of these new development deals, with the key point being the inputs have to be defensible. And that's why I really am imploring investors to make sure that they understand the domain of the inputs. Like, you know, especially if you're a deal picker, you really do need to understand them. That transitions, Jay, into a question we had. We're moving to live. You mentioned long-term holds, and you mentioned, you know, buying or developing great real estate with a long-term philosophy. So can you talk a little bit about permanent capital and real estate and how that's changing, you know, from sort of a closed-ended fund model to more and more an open-ended model that allows people to hold longer?
Oh wow! Well, you could probably answer that better than I can. I would just generally say, you know, the first part of the question of the kind of longer term nature. I'll tell you in particular, you know, where you all have been talking about, like the Sun Belt of, you know, I think these markets. I get a lot of questions about, you know, the longevity of these markets, and you know, I still think we're in the early innings. You know, you look at the affordability story in these markets relative to coastal markets. Look at the regulatory risk factors that have been much more heightened in the coastal markets. You know, I think there's still quite a bit of opportunity long term, but no, I don't want to fancy myself as an expert on fund structure, so I'd probably defer that one.
Yeah, what we do, I can just speak to how we approach it. We've seen the power of compounding and the destructive power, by the way, of making really good returns, but then paying cap gains and reinvesting it post-tax. We used to have that model of closed-ended, and you really wind up paying the government way too much in taxes as a tax investor. If you're in a fund, you get a high IRR, but it's a 4 or 5 year hold, and then you pay taxes, and then you do it again. And there's cash drag and the whole thing. So we really try to encourage investors to have a longer term mentality. Real estate, especially multifamily, it's such an amazing long-term wealth builder because you, in addition to everything else, you can depreciate it. And so you get your dividends, but you're not really paying taxes and you're deferring, and you can set up these wonderful structures where you really do defer indefinitely. That's how the really wealthy people invest. And that's how folks that, you know, are working hard to get ahead need to start about, you know, thinking about more is their post-tax return. And so we write about that a lot. Long-term holds is the cliff notes of how to do that in real estate. I had some requests to send the Wall Street Journal article. I don't know if I can do that or not. I'll talk to marketing. Thanks for that request. Here's one for you, Jay. It sounds like you have some background on regulatory. We get this question a lot about QOZ law and if the program could be extended and some of the early benefits, such as the deferral of the original capital gain being deferred. Do you have any insights into that?
On the, did you say on OZ and Opportunity Zone?
Yeah, the QOZ law, there's been a lot of chatter about how the Congress is going to extend that law further than the deadline of 2026.
No, I'm not up to speed on the latest of that, but I'll tell you, I mean, as you mentioned, when I was speaking of regulatory risk, I'm more referring to, I think there's been a migration of capital away from the high regulation cities. And frankly, I think a lot of investors just don't want to have to deal with the challenges and the headaches of being in some of these cities right now. And they're, kind of migrating to the same places a lot of the population is. But on the other side of that, I think there's a macro tailwind in favor of housing creation right now. There's a lot of pressure on Congress as well as city councils at all levels to increase housing supply, and especially if there's an affordable or workforce component or a revitalization component to it. And so I'd be very bullish on anything where you can attach yourself to programs like that, because you're going to face a lot less opposition, and as well as you're going to see obviously some subsidy benefit to it as well.
Yeah, I completely agree. So if you look at our activity, we have 1,400 units in development in Colorado Springs. Why? Well, because in addition to the QOZ, the Colorado Springs City Council wants housing. There's so many people moving there, they need housing. And so they have, for the past 3 or 4 years, they've had essentially they're waiving 75% of your taxes for 10 to 15 years to encourage that. And now they're phasing it out. But like, those are the types of incentives that get us excited, because, we talk at the 10,000 foot level, but a deal is eventually idiosyncratic. It's a deal. Does it make sense? And, waiving a huge expense for 15 years helps. There's similar programs in Texas. There's a new one in Florida. They're talking about doing one in Nashville. It's in the very early phases, but this is the benefit of having people who live and work and integrate on the ground, which we have, is you get into the know of what's happening, because real estate is largely local, meaning the city councils, it's local to that city, sometimes to the state, sometimes to the city. It's important to know that stuff.
I agree.
I have a question in the chat, and this is my favorite part, Jay, because do you remember what I said at the beginning? Please put your questions in the Q&A, and yeah. I do it every webinar, and then there's these wonderful questions in the chat, which I love.
Yes.
Anyway, the question is, you and I talked a lot about short-term supply, and then we talked about the strength of long-term fundamentals. Where do you think that intersect is, where the long-term fundamentals are sort of usurping the short-term supply challenge?
Oh, that's a good question. Well, I would tell you, it's like they're never, we all are kind of thinking in terms of like reversion to the mean, but like the mean is sort of like something that it's like this mirage that we're always chasing. Like usually we are going up above the mean and down below the mean, and the mean is just whatever's in the middle. And so rarely are we ever in real balance. I think there was a period of time in the 2010s decade where we were there for a little while, but my view of what happens in these things, everything's cyclical. And so right now there's more supply than demand. I think we'll be there through 2024. I think 25 and 26, you're going to see more downward movement in vacancy, lesser vacancy, and more rent growth. Then we'll start building more again. And then you look at 27 and 28, I'm guessing there'll be a lot of supply again by that point.
Yeah. One thing we didn't touch on, and this isn't a question from the audience, but I want to circle back. What is your opinion on build for rent? It's certainly talked about a lot. Origin has I get this question a lot. Are you involved in build to rent? Yeah, we have thousands of units that are built for rent in development or pre-development. And also, I'll call it age restricted. So not senior housing, not operational, but simply a multifamily building that has a 50 or 55-year-old age minimum, which unfortunately, Jay, I would actually qualify if it was 50.
I'm sorry to hear that.
So I will just go on the record. I would be able to enter that community if it was 50. But what is your opinion on those asset? They're not asset classes. It's multifamily. They're sort of like sub-asset classes.
Subtypes, yeah.
Yeah.
I love the build to rent category. And I think I put an article about this recently about this topic, but I personally, my one theory I have, I think you're going to see more institutional reallocation of capital away from scattered site single family rentals and into build to rent single family communities. And the reasons are very simple. You're creating net new housing, so you're not going to have the same regulatory pushback in terms of, we're seeing this narrative of Wall Street buying up houses and no matter the fact that home ownership is actually going up, not down, but and so on top of that, though, it's much easier to deploy capital, one big check as opposed to hundreds of small checks. It's easier to manage one property as opposed to 300 scattered properties. But also too, the demographics there, you're serving an underserved niche. It's a category of people who've aged out of a traditional apartment. They probably got kids. Most families with kids, they don't really fit into most apartments as they're being built these days. There's not playgrounds. There's not a lot of 3-bedroom units. You're not going up and down stairs. It's not suitable for young families. And so the build to rent communities, I think it's for that group of people who are either, empty nesters that don't want to buy, don't want to be a homeowner, but still want detached homes, a little bit of a yard. It's for young families that aren't ready to buy right now for whatever reason. Maybe they're building a house or new to a city, trying to figure out where they want to be, or maybe they're just not buyers. And they still want all the amenities of essentially managed property where they're not having to mow their own yard and, they're with other renters, there's pools, there's a clubhouse, all the type of stuff. And so I could go on and on, obviously. I'm very bullish.
You're passionate about build for rent. I share it, and I would add, like, the key to build for rent is finding the sites, because you need a big site. I mean, by definition, it's horizontal construction. It's not vertical, right?
Yeah.
So you need a big site, and you can't overpay for land, or it won't make sense. But you need that land to be walkable or certainly drivable to some semblance of amenity set. And so you're threading the needle here to try to find these land sites are just imperative to making this work. That's where a lot of the value is unlocked. In terms of operating costs and construction costs, you're doing better, and the models will bear this out. You're going to find a little bit higher margin. Construction costs are a little bit lower per unit of rent, and the construction time is a little bit shorter. And ongoing operating costs, if you think about juxtapose a build for rent community with an underground, parked, elevator served, dense multifamily, podium, or high rise, there's an awful lot of non-revenue generating space in a high rise. A lot, right? So you've got heated parking, it could be revenue, I guess, if you charge for parking, but revenues, interior hallways, et cetera. I mean, there's a lot of space you're paying for to operate, not generating revenue from. So that's a bit of a trap in multifamily. Again, something to think about. When you think about replacement costs as a unit of measure, you can't get too carried away there, because it's only what the renter's willing to pay for, the value they recognize. If you're paying more for construction and not getting value, maybe you just paid too much for construction, right? And that's something to keep in mind. Okay, so we have a question from Mario. Thank you for your question. He's trying to quantify how this works if things were to get a bit distressed. So if a multifamily is worth less than the value of the loan, and then the owner can't pay back the bank, and so a firm like Origin comes in, how is Origin fitting into this equation? Like, are we dealing with the owner, or are we dealing with the the loan? Are we trying to buy the loan? Or like, he's trying to figure out how all this works. And I've actually had people in the industry um, ask me this question. Like, I'm trying to buy this debt. How would I do it? And it's interesting, Jay, because if you weren't around in '08, 9, and 10, you haven't seen it. Like literally, if you're 35 years old and you've been in real estate 10 years, you have no experience in this, right? There's been no occasion, but it could be that you're going to see it again. Origin is very experienced in this. We did entire funds that was only distress, but I can answer it. But if you want, take a crack at how all that would work.
No, I would defer this one to you, since this would be more your, what you're going to have to do in the real world. Yeah.
Yeah. Well, what winds up happening is, again, it's state by state, because certain states have much more difficult foreclosure and possession laws than others. So if you're talking about a loan in Texas, it's very different than a loan in Cook County in Chicago. In Chicago, there's more leverage with the owner, with the equity, because it takes so long to get through the foreclosure process. In Texas, it doesn't take long, so there's much more leverage with the lender. So as private equity or a buyer in this case, I have to be cognizant of the leverage points. That's idiosyncratic to the deal. But generally, I'm trying to buy the loan. And with the loan, you assume all the rights of the lender, nothing more. But those rights would include trying to get a deed in lieu, trying to restructure the loan if that's what you want to do, or foreclosing out the borrower to take possession of the asset. And all of that would be priced into a model based on duration and risk and cost of capital into the business plan itself. I hope that helps. I think we have time for one more question, and this was pretty good in terms of what we covered. So Scott, thanks for your question. He's trying to unpack what we were talking about with affordability. He said you talked about 20 to 30% of income. Is that gross wages or take-home pay after taxes, et cetera? You want to take a crack at that one?
Sure. Yeah. Typically, when we look at income in the rental housing industry, it's the gross income, because you're getting what's reported in the application. And so they're usually showing their paycheck. And so you're taking or they're reporting their annual salary or monthly salary. And so it is a gross number in that case.
And I will take the last one, which is from Julia, just came in. It says preferred equity is offering 20% to passive investors. What do you think about this investment versus an LP on multifamily, et cetera? So Julia, I was mentioning to Jay, we're in multifamily, we're one of the more active groups in the country based on volume. That's not the rate of return that we get. It's more like 14, 15%. But again, when you're thinking about preferred equity, you mentioned preferred equity. I don't know if that's on multifamily or on hotel or on retail or on office. I have no idea. You might clarify. But anytime you're looking at risk, you have to there's units of risk in different buckets. So one would be, what asset class is it? And so if I told you everything is similar about a deal, but one's a multifamily deal and one's an office deal, the office deal is riskier. It's a more risky asset class. We don't even know the demand function of that asset class right now. Hotel is riskier always because the leases are one night. So there's no bond portion of a hotel lease. It's going to move around radically, whereas a multifamily lease is a year contract. So there are fundamental differences at the asset level. Then there's idiosyncratic risk. That's deal level risk. So a development is riskier than a cash flowing asset. Any banker would tell you that. So now that's another leg to the risk. The next leg to the risk is, and this is a really important one in preferred equity. I've written quite extensively on this. Your rate of return on equity is radically a function of your position in the capital structure. So if I told you that you're the pref equity between 70 and 90%, that's very different than being the pref equity 50 to 70%, right? And so like all of these things really matter. And that's why I'm going to go back to what I said before. Please either hire a manager that spends all their time on this stuff and trust that process and trust spend the time on manager selection. Or if you're going to go deal by deal, please be trained in finance and real estate and domain and risk management, or hire a consultant, because you work too hard to make your money, and you're an expert at something I'm not. And maybe you can fix my arm if I break it. You're a surgeon. Or maybe, I don't know how to fix my car. I mean, there's so many things I don't do well, but yet people somehow think in real estate that they're going to figure it out. You won't, right? Unless you dedicate 40, 50, 60 hours a career, you won't. It's not a fair assumption to make. And Jay, maybe we'll just leave with this. And I have an opinion on it. I'd love to hear yours. Why do you think that in real estate, people have a familiarity and a feeling that they understand how to do these things when they wouldn't in venture capital or biotech or any of these other modalities? Why do you think that is?
Well, David, this question is exactly why I'm still in this industry, because I've fallen in love with just the ability to have a job that gets to better inform what's been a lot of conventional wisdoms that aren't really backed by data. And there's so many examples of that. And housing and rental housing in particular, it's very, it's very relatable. We've all been there. We have, family, kids in there. We've lived there. We see it, we can touch it, we see it in the news. But it's like you said, I like the analogy, sure. It's just like any other field. It's actually really nuanced, and there's very specific things you got to deal with, and problems and opportunities, and the inputs you look into. I mean, it's one thing just to know what it's like to look at and live in a community. It's another one to understand how to make it work. And I think it's one of the great things about our industry. And frankly, there's still a lot of investors I don't think fully understand our industry, for that matter.
Yeah, I agree. I think it's because we're so familiar with it. That's my answer. We all live in a home or an apartment. We consume the product, and so it's relatable, and somehow that de-risks it in our mind, but it isn't riskless, right? It should be approached the same way. And by the way, I'll end with this. Like any other industry, 10% of the people will make 90% of the money. It's no different than any other industry. I mean, if anyone's watching NVIDIA today, NVIDIA has a bigger market cap now than probably all the other semiconductor companies combined. Why is that? Well, it's probably because 10% of the people make 90% of the money. Real estate's no different. And you have to figure out how to be on the 10. Jay, thank you so much for your time. I hope you enjoyed it. I certainly did. And we had a tremendous amount we had 1,100 registrants, and I checked, we had 400 people actually came in live, which is like a record amount on a awesome. Thursday. And the weather's pretty good too, so we were competing with that. So thank you very much. I appreciate it. Have a great Memorial Day weekend.
Thank you. Thanks for having me.
Thanks for being on, everyone. Bye-bye.